up reversal patterns, and now we'll go ahead with continuous patterns. So what are continuous patterns? A continuation pattern in the financial market is an indication that the price of a stock or any asset will continue to move in the same direction even after the continuation pattern completes. There are several continuation patterns that technical analysis use as signals that the price trend will continue. So these are not generally formed at the bottom or peak of the rally, but in middle. So whenever there's a stock which is rallying, you may see sometimes there's a small correction in them or it goes sideways. So that's when the continuation pattern is formed, and eventually it breaks out of that pattern and the momentum continues in them. So what we had taken up last time was reversal patterns. Now we'll take up continuous patterns. And there are 4 types of continuous patterns that are triangles, flags, channels, and cup and handle. Now there are 3 types of triangles. The first one, symmetrical triangle, ascending and descending. Now we know all 3 because we have done this in geometry in our primary school. It is very simple that when there are 2 trend lines, one joining all the peaks and one from the bottom joining all the lows, and they coincide and they all basically are converging at roughly the same equal slope, is called a symmetrical triangle. Ascending triangle is when a price moves that allows for a horizontal line to be drawn along the swing highs. So there is a horizontal line at the top connecting all the highs, and there is a rising trend line from the bottom connecting the lows. That is called an ascending triangle. A descending triangle is when there is a horizontal line connecting all the lows and there is a trend line connecting all the highs down. So that is called a descending triangle. We'll see examples of these as well to understand better. Now, the first one I want to give you is showing you a broader chart, because why do we call this a continuation candle is in Asian paint, the rally was continuing. There was a small correction, then it consolidates. There's a symmetrical triangle. It breaks out and the rally continues in that. So this is not formed at the top or bottom, but while the rally is continuing. Now we'll see it closer. Now this is the symmetrical triangle formed in Asian paints. The target of this is basically the first, that is the high or the low, whichever is formed first, to form the triangle from there till the bottom of that. So this, when cloned over here, gives you the target. When the candle breaks out of the resistance line on the upside is a breakout of the symmetrical triangle. You buy when it breaks out over here, there's a confirmation candle, and then you buy when it sustains above the high of this candle. So you enter somewhere over here and you see the target is precisely this. It has just tested that, corrected or consolidated over there and moved up. So how beautifully the exact target is achieved from the breakout point. So you cannot always enter at the right at the breakout point. It is always advisable to enter once it sustains and confirms from there. If in case of, it had broken down from here, it would be a symmetrical triangle breakdown. It would not be a continuation pattern, then it would have become a reversal pattern. Now you have another symmetrical triangle in Divi's lab, which is recent. And now it is breaking out from there. And based on the calculation of this, the target comes to 4,672. Now note this, we'll get to know in the next few weeks whether this target is getting achieved or not. There's another symmetrical triangle that is being formed, or just formed right now, was in DMART. Now you see, one thing is, in all these, the slope, both are very symmetrical. The angle of both the trend lines, the top and bottom, are symmetrical. It has broken out from here. So this would be the length of this, from this candle all the way down, would be the target on the upside from here. Now when you enter, this is the risk reward is very good over here, because let's assume that you have bought somewhere here around 3,000 levels after the breakout. Your stop loss is below this candle and your upside is substantial. It is very similar what we have done in the trend lines. Now this is ascending triangle, where there's a horizontal line connecting the highs there is a rising trend line from the bottom connecting the lows. This is an ascending triangle. Now, a breakout of that is when you enter. The stop loss is below the low of this candle, and you enter once this candle high of this candle is crossed on the upside. It gives you a target of the from, let's consider the high of this till the low of this, which will be whatever will be the target of whatever will be the length of this will be your target on the upside over here. Now this is in Manewar with this is a recent IPO stock, Vedanta Fashions. This is another ascending triangle connecting all the highs and a rising trend line from the bottom, a breakout of that. Now, whatever is the length of this will be your upside target on the upside over here. Your stop loss will be below the low of this candle. It did not break. It did come down, but did not close below this. So reversals from here is a good opportunity to buy because this is retested. Now, descending triangle is when there's a horizontal line connecting all the bottoms, all the lows, and there's a sloping trend line connecting all the highs. This is just the opposite of the ascending triangle. Now, breakdown from here is what leads to a fall. A breakout from here will be a continuation pattern. Now, in Asian Paints, this has failed because this is at the peak. Now, this in case of a breakdown, a failure, it is not called a descending triangle anymore. It becomes a wedge. Now, the difference between a triangle and a wedge is that a wedge is usually formed at the top of a rally or a bottom of the rally. The shape is the same, but when it is in the continuation, it is called a triangle. So now this descending triangle as a pattern, when it was done till here, it was a descending triangle, but it failed and it broke down. After the breakdown, it is reversing now, but this can typically be called a wedge. Now we'll come to the second one, that is flag and pole. Now, bullish is found in stocks which are in strong uptrend and considered good for a continuation pattern. A bearish is found when the stock is in a strong downtrend. Example of this is when Tata Motors was in a good strong uptrend. This is the pole, and then it consolidates to form a flag. Breakout of this will give you a fresh breakout for the rally to continue on the upside. The target is the height of this particular range is your first minimum target. You can also add the length of the pole as your subsequent target. Now, this is a bearish flag. Delta Corp, this is your pole, and this is your flag pattern on the downside. Breakdown from that is your first target will be the length of this. Here it has, obviously because of the gap down, it has given you a higher one. And if the weakness continues, you can even add the length of the pole as your target going forward. Coming to the third one, that is channels. Now, there are three types of channel, that are rising, falling, and flat. Now, typically, what is the channel is nothing but two parallel lines. Now, if the parallel lines, the stock price moves between that. If the parallel lines are moving upwards, it is called a rising channel. If it is falling, sloping downward, it is a falling channel. And if they are horizontal, it is a flat channel. Now, this is a rising channel. There are two parallel lines and the price moves in between them. If it breaks out on the upside, the size of the two parallel lines is your target on the upside. Whenever it breaks out, the low of that candle is your stop loss. You have to buy once it crosses the high, and that's when you enter for your target. And determining the target is very easy because this is the length of the two parallel channels is your upside target. Now, the risk reward here can sometimes get tricky is because your breakout candle can be really big. And then you buy above the breakout candle. So your stop loss just becomes a little more deeper. So breakout of rising channels, if the size of the breakout candle is way too high, your risk reward can get a little disturbed. This is another one. So Star Health was again in a rising channel, but it broke down. It didn't break up. It could have reversed from here and it could have tested the upper band of the channel, but it broke down from here. Now, in this case, the target can be determined whatever is the size of the channel. On the downside, would be the same, would be your target. And in all cases, the time frame to achieve the target is usually 1/3 the time it has taken to form the pattern. This is another in Dow Jones. Dow Jones was in a channel rising upside. This was the length of the channel. It broke down. The same was cloned here, and that's exact the target where from where it reversed. Now just see how beautifully it is, testing just the precise target level, levels. And it has reversed exactly from there. Now this is a falling channel, just the opposite of rising channel, where there are two sloping parallel lines and the price action is between these two. In this case, it did not fall, but it broke out much earlier. That is APL Apollo. Now, whatever is the length of this gap between the upper and lower band of the channel will be your target on the upside over here. So whenever it breaks out, the low of the candle is your stop loss. You enter above the high of the breakout candle, and then you can ride the entire rally upside. In falling channels, that is the advantage. Your risk is very low versus the reward that you get, unlike the rising channels. There's another example, HDFC Life, falling channel, breaks out, and whatever the length between these two will be the target on the upside. So it should come somewhere over here. Another one, GMR Infra, falling channel, breaks out, and now the target will be the difference of these two. The stop loss would be below the low of this. It did not close below this, though it did go intraday below that. Now horizontal. Now this is, I prefer this as the best among the three channels, because one, these are static lines. The levels are not going to change. Your stop losses are fixed. You don't have to worry after the breakout or breakdown. And it is very easy to identify whenever it's a horizontal channel. Now this is case of UPL. It was consolidating between these two parallel lines, and it broke down from here. And now the target of this will be the difference between the higher and lower band. Same thing happened in Sun Pharma the other day. It gave a false breakdown and reversed completely. Now this is Maruti. Maruti, it was consolidating between these two parallel lines, and it breaks out from here. The target on the upside is nothing but the length of this channel. Coming to cup and handle. Now, cup and handle is very simple. How we know is a cup and there's a handle along with that. Most of the charts that I discuss in the weekend analysis are just the cup, because a breakout of the cup without having a candle is a stronger pattern. But very often it happens that there's a cup and there is a handle. The size of the handle is usually 1/3 or 2/3 of the size of the cup. And a reversal from 1/3 is a stronger handle because it has not corrected much. 2/3 versus will be a little weaker correction. So depth of the cup is the minimum target on the upside. The second target will be the depth of the handle. Now this is silver. We discussed today. This is the cup. So there are two adjoining highs, and then there's a handle. The handle is approximately 1/3 to 2/3 the size of the cup. When it breaks out from here, your first target will be the depth of the cup. Your second target will be the depth of this handle. And these patterns are usually sure shot. The success rate is very high. After breaking out on confirmations, you keep adding. Don't buy all the quantity in one go. Your stop loss is below this resistance lines, which will eventually become a support line. If the support line breaks and closes below that, you can exit your positions. So your risk reward is very good in such cases again. And again, these are not formed at the bottom of the rally. They are always as a continuation pattern. We would have seen silver prior to this moving upward one way. After that, for a few months together, it consolidated, formed another handle and moved up. Now you see the same thing happening in PNB. There's a rally. After that, there's a continuation pattern of cup and handle, right? And this is breaking out. The first target is the depth of the cup, which is coming to 94. Your second target will be the depth of the handle as well, which is coming to 9900. Now this is Nifty. So you can see Nifty also gave you a cup and handle breakout. Your first target of Nifty is the depth of the cup. We have already broken out. We have retested. We are moving up from there. So the first target comes to 22,500 or 600. After that breaks out, your second target would be the depth of the cup, a handle, sorry, that comes to 24,800. Now let's see whether these are realistic targets. Time will tell us. This sounds too optimistic. So as an index, we have to be cautiously, be bullish and not get too over optimistic. Obviously, the trend is continuing and we'll ride the rally without worry right now. Now, this is happening in Dow Jones as well. There's a cup and there's a handle. And the handle is approximately 1/3 the size of the cup. So now this has broken out. Your first target of Dow Jones is 42,500. So now we all know where Dow Jones is headed. This high can now be a resistance where it will consolidate. If it breaks out from there, the first target is 42,500. Now we have Bajaj Finserv. There was a rally, there was a correction, and the pattern continues after forming a cup and handle. Now this has broken out already, and your first target is 1879. This is not Bajaj Finance, this is Bajaj Finserv, sorry. Now, inverted head and shoulder is nothing but the opposite of, inverted cup and handle is the opposite of cup and handle. It is a bearish pattern formation. Now, this is SRF. There's a cup over here. There's a handle over here. This is the line. This is the support line. Break of that, the fall will start from there. You can enter your trade over here on break of the support line. And your first target is depth, the height of the cup. Now this cloned over here, this is exactly where it has come and stopped and reversed from there. The second target, if the breakout would have continued, breakdown would have continued, the second target would have been the depth of the handle. Now IDFC first is forming a inverted cup and handle. If it breaks down from here, which is the support line of the cup and handle, your first target comes down to 60, 61, which is the depth of the cup. Now let's see whether IDFC breaks down from here or reverses from here and continues the rally. Now this is forming at the peak. This is not going to be a continuation pattern if it breaks down. It'll be a reversal pattern. So wedges are very similar to triangles. Triangles are continuous patterns while wedges are reversal patterns and form at the peak. The shape of both wedges and triangles are the same, just that the placement of it is different. Pennants, similar to triangles, pennants are formed over a shorter period of time span, that is over a few days, while triangles are formed over much larger period of time, maybe a few weeks. So only difference between pennants and triangles are the time frames. So this is all for the continuation patterns. And these are patterns that we come across very often in our trades, which we also share with you.